What if I told you one bank controls more money than the GDP of most countries and has survived every major financial collapse of the last 150 years? Not by accident, but by design. While thousands of banks disappeared during crises, one institution kept absorbing the wreckage. And today, it quietly holds over $3.9 trillion in assets. This is the story of how JPMorgan Chase didn't just survive capitalism. It mastered its darkest loopholes. In the next few minutes, you'll discover the crisis strategy that turns economic collapse into expansion, the hidden revenue streams most people never see, the psychological leverage banks use against governments, and the one system that makes JP Morgan almost impossible to destroy. This isn't about conspiracy, it's about structure. Because when you understand the structure, you understand why some institutions never lose. Here's the first secret. JP Morgan grows fastest when the world is falling apart. In 1907, during the panic of 1907, banks were collapsing overnight. Markets were frozen. Trust evaporated. Enter J.P. Morgan. He personally locked bankers inside his library in New York and forced them to stabilize the system. That crisis cemented something critical. JP Morgan positioned itself as the rescuer. Fast forward to 2008. When the financial system imploded, most banks were begging for bailouts. But JP Morgan Chase did something different. It acquired Bear Stearns for just $2 per share initially. Washington Mutual, the largest bank failure in U.S. history. Washington Mutual had $307 billion in assets. JP Morgan bought it for $1.9 billion. That's less than 1% of its asset base. Crisis doesn't destroy giants. It feeds them. And here's the part nobody talks about. Governments prefer strong banks during panic. So when chaos hits, regulators quietly help the strongest institutions absorb the weak. It's capitalism's version of natural selection, but accelerated. Let's zoom in. During the 2008 collapse, JP Morgan didn't just survive. It expanded market share in investment banking, deposits, credit cards, and asset management. While competitors shrank, JP Morgan's balance sheet exploded. By 2010, it emerged as one of the most systemically important financial institutions on earth. Why? Because of one word: confidence. In banking, perception is oxygen. Depositors don't run from strength. They run from fear. And JP Morgan's brand, reinforced over a century, became synonymous with stability. Psychologically, during uncertainty, money flows toward perceived safety. That's not finance. That's human behavior.
And JP Morgan understands human behavior better than most governments.
But crisis acquisitions are only layer one. The deeper system is far more sophisticated. Most people think banks make money from loans. That's outdated thinking. JP Morgan generates billions from investment banking advisory fees, trading spreads, asset management fees, credit card interchange, and corporate treasury services. In 2023 alone, JP Morgan reported over $160 billion in revenue. But here's the key. Fees are safer than loans. When markets rise, trading profits surge. When markets fall, volatility increases trading volume. When companies expand, advisory fees spike. When companies panic, restructuring fees spike. The system monetizes movement itself. It doesn't need the economy to be good. It needs it to be active. As the largest U.S. bank by assets, JP Morgan sits in the center of financial movement. Every IPO, every bond issuance, every currency swap, every merger, there's a high probability JP Morgan is collecting a slice. It's not just a bank, it's infrastructure. After 2008, regulators labeled JP Morgan a systemically important financial institution. If it collapses, the global economy collapses with it. That sounds like a liability. It's actually leverage, because when an institution becomes essential, governments cannot afford its failure. This creates what economists call an implicit guarantee. Even without explicit bailouts, markets assume support will come if needed. That assumption lowers borrowing costs. Lower borrowing costs increase profitability, and increased profitability increases dominance. By 2023, JPMorgan's market capitalization exceeded many global banks combined. Its CEO, Jamie Dimon, has led the firm for nearly 2 decades. Under his leadership, the bank navigated the European debt crisis, survived COVID volatility, and acquired First Republic Bank in 2023 after another banking scare. When regional banks trembled, JPMorgan expanded. Again, notice the pattern? Stress equals opportunity. But here comes the twist most people miss. The real secret isn't size, it's network centrality. JPMorgan clears trillions of dollars in transactions daily. It provides liquidity to hedge funds, custody services for asset managers, payment rails for corporations. It's embedded in the plumbing of global finance. Remove it, and settlement chains freeze. This makes JPMorgan less like a competitor and more like electricity. You don't compete with electricity. You build around it. The larger the network becomes, the harder it is to displace. Because switching costs aren't just financial. They're systemic. That's why smaller banks can innovate, but giants endure. Let's step back. Why does this model work so well? Because it aligns with 3 psychological truths. Humans panic in uncertainty. Humans trust established brands in chaos. Power concentrates when fear rises. JPMorgan doesn't need every year to be perfect. It needs volatility cycles. During booms, it scales. During busts, it acquires. During panic, it absorbs deposits. During recovery, it monetizes growth. Position yourself as indispensable during instability. That's not just a banking strategy. It's a wealth principle. Industries that become infrastructure don't chase customers. Customers depend on them. The largest fortunes are rarely built on products. They're built on systems. JPMorgan mastered system control over a century ago. JPMorgan Chase didn't become the largest bank in the world by avoiding crises. It became the largest by feeding on them. Through crisis acquisitions, fee extraction dominance, infrastructure centrality, psychological trust positioning, and implicit systemic leverage. This is how modern financial empires operate. Quietly, strategically, almost invisibly. If you found this revealing, the next video breaks down how private equity firms buy companies with borrowed money and walk away richer even if the company fails. Because once you see how elite money systems really work, you can't unsee them.